I often see agency CEOs tracking 20 plus KPIs, spending hours in spreadsheets every week, and still not having the clarity that they need to make confident financial decisions. Now here's the thing, there's only 5 KPIs you need to track in your agency to have complete clarity over your financial position and to know what levers you can pull to unlock profitability and cash flow. My name is Rayhan, I'm a chartered accountant and the founder of Sidekick Accounting. I've helped hundreds of agencies make more money and pay less tax. In this video, I'm going to show you exactly which metrics you need to track in your agency, why you need to track them, how you track them, and what they mean for your business. So here's what I usually see when an agency tells me they are tracking KPIs. Revenue tracking, yes, everyone does this. However, there are levels to it. Are you tracking gross revenue or net revenue? Are you tracking invoice revenue or cash collected? Getting this metric wrong means that everything else you look at through your P&L and ultimately in your bank account is not going to be right, and you will always feel like you make predictions and you're getting them wrong. The other one is profit margins, and you'll be surprised not everyone tracks profit margin, but when they do, there are also levels to this. Are you tracking net margin or gross margin? Are you tracking profit after tax or before tax? Are you looking at profit at a service level or a client level or just overall for the business? There's a huge difference, and each profit metric will tell you a different story. And finally, cash flow. Everyone knows the importance of cash flow for an agency. A lot of agencies think they are managing cash flow, but the reality is all they're doing is looking at their bank balance at a point in time. This is where you get into trouble. So the issue here is agencies are tracking vanity metrics, not the metrics that actually help you make decisions in your business to unlock profit and cash flow. So with that in mind, let me show you the 5 KPIs every agency CEO needs to track. Number 1 is adjusted gross revenue. Now I want to be specific here with adjusted gross revenue, not just revenue, because there is a difference. Adjusted gross revenue basically means revenue that you keep. You strip out pass-through costs like media spend or influences that your clients may pay you for that you then pay out. You strip out revenue taxes like VAT, and this will give you your adjusted gross revenue number. Now, if you are using an accounting system and you have a qualified bookkeeper or accountant managing that for you, what you see going through the revenue line should represent this number. However, not many people are doing this correctly, which is why we need to define it. So why we track this metric? Because it's a standardized revenue metric that you can compare yourself to other agencies on, and you can compare yourself to previous months, weeks, quarters. So this KPI I would track as a 4-week rolling average. What this will tell you is that if your 4-week rolling average of adjusted gross revenue is declining over time, you're going to have an issue in a couple of months or a couple of weeks' time. It gives you a proactive forward-looking view based on a trend rather than what's happening at a point in time. So if you see this trend of your rolling 4-week AGR declining, you know that you need to push the gas on new business or you need to adjust your pricing. So that's metric number 1. The second KPI you need to track is your cash runway. Now your cash runway is quite simple. It tells you how many weeks of cash you have in your bank at a point in time. It's your total bank balance divided by your weekly burn rate. So if you have £80,000 in the bank and you burn £20,000 on average per week, you have 4 weeks of cash sat in the bank. When you put it this way, it doesn't sound like much. Here's the thing, agencies have unpredictable cash flow. And on top of that, they have very fixed costs being teeth. So you have to pay your team and make payroll at the end of the month, but your clients may delay payment of their invoice for 30 days outside of your control. Your cash runway will tell you how long you can weather the storm. Simple traffic light system could work here. So green is if you have 8 or more weeks of cash in the bank, amber is if you have between 4 and 8, and red is if you have less than 4. If you're in that amber zone, you need to accelerate collections to get more cash into the bank, or you need to reduce expenses. If you're in red, you need emergency cash flow planning. That might be having a backup source of funds in the form of an overdraft, invoice factoring facility, or even personal funds that are ready to put into the business in the event of a late paying client or a cash flow crisis. Track this metric every Monday morning and it might just save your business. Now, number 3 is team utilization. As an agency, you are selling your team's time for money. If your team are not effectively being utilized, it will impact your profitability and it will impact your cash flow. Now, utilization rate can be calculated as the billable hours, so the hours that somebody spends on client work, divided by their available hours, so their contracted hours. It's expressed as a percentage, and you'll be so surprised how simple it is to calculate, but how few are measuring it. Now, you might think, why do I need to know this? I feel like I've got a good grip on what my team are working on. Here's the thing with team utilization. Poor utilization compounds very quickly. The purpose of this KPI is to give you advanced warning of a potential issue. If your team are at 60% utilization this week and next week they're at 50% and then the following week they're at 40%, you've got notice and you've got data and a trend to say, okay, we have a longer term trend of a lack of utilization. Therefore, maybe we need to let some team go. Why? Because it's indicating that you are burning cash that you do not need to be spending. Nipping it in the bud and knowing this before it turns into a situation where you have no cash flow, you have a team, and it's very emotional, will allow you to make good decisions as an agency leader. In terms of benchmarking and what you should be aiming for, 75 to 85% is optimal for an agency. That remaining 15 to 25% accounts for time that people will be down due to training, sickness, holidays, and other things that happen. If your utilization is 90% plus, typically your team are going to burn out and it's not a healthy place to be for a prolonged period of time. This is telling you that you need to hire. And if it's below 70%, you probably want to dig deeper to understand where people are spending their time and whether they need to be spending that much time in the business. If you want to get more granular around team utilization so you can understand if the strategy team is at 90% but your content team is at 60%, you would start to track this and cut the data based on departments. This is going to tell you where to either focus your new business effort to win new work to plug the capacity gap, or where you can optimize your team and your cost structure to unlock profit and cash flow. It also might just tell you to redistribute work because person A has capacity and person B is burning out. And the final thing I'd suggest is track non-billable time. So even if they are not working on clients, you want to know how many hours they're spending in meetings, doing training, or admin. All of these activities are necessary, but they should be capped at between 15 and 20% of somebody's paid time. Number 4 is your project gross margin. This is your gross profit margin tracked at a project level rather than agency-wide. Some agencies know their gross margin overall, but they're not able to say this client is profitable and this one is not. This is crucial for making the right decisions for the agency, whether that's an upsell, an increase in price, or simply getting rid of non-profitable clients. Project gross margin is pretty simple. It's how much money do you make from this client, how much do you spend on this client in terms of subscriptions, software licenses, and team time, and then what's left expressed as a percentage of the revenue they generate. You want to track this weekly for all projects. Why? Because you want to see trends over time. If a project's profitability is trending down over time, that could indicate that there is scope creep, there's an increase in cost, or it's being over-resourced. In any case, it will indicate a conversation needs to happen. And the 5th KPI is your accounts receivable aging. This is your early warning system for cash flow problems and for action in terms of credit control. Simply put, this measures how many invoices are unpaid and how long they've been unpaid for. Typically, it's bucketed up from 0 to 30 days, 30 to 60 days, 60 to 90 days, and 90 days plus. You want to aim to have at least 30% of your receivables in the first bucket, 0 to 30 days. In that middle bucket, ideally you'd have none. However, typically you will have some in there where there may be fee disputes, you may be actively chasing clients or escalating it through your credit control process. And ideally you'd have 0 in 60 days plus because that is a cash flow nightmare and it's too late for you to at that point trigger credit control processes that should have kicked in a long time ago. Reviewing this weekly and taking action will help you spot cash flow problems before they become a problem. They'll help you have conversations with the clients and take action as needed, potentially pausing projects and escalating it through a legal route. So that's the 5 KPIs every agency CEO should be tracking. Now you might be asking, how do I implement all of this? Well, if you have a good accounting system and a bookkeeper in place that's maintaining it, a lot of this data will just fall out of it. However, if you don't, you can also very easily manage these 5 KPIs in a spreadsheet. Now, these 5 KPIs will not take long to track every week. However, what they will do is give you an advanced warning of any potential issues that will arise in the next few weeks. Now, because I want to make this as easy for you to implement as possible, I also have a financial planning template that I'll provide a link to in the description. In this template, you can input your numbers and you'll get these KPIs plus a lot more out of the back of it. And if you maintain it yourself every week and every month, you'll be able to get this data in a dashboard style for free. Click the link below to download it. As always, if you found this video useful, give it a thumbs up and subscribe to my channel for more agency finance tips.